how risky is the stock market?
Bum, bum, bum.
Really? Really?
Yeah.
When you look at the stock market up close, it can sure seem like a gamble. But you might be missing the forest for the trees. So how risky is the stock market really? Let's find out.
To start, let's track one company's share price for a year. The way the market is going these days, it might look like a
Roller coaster ride! Who'd want to take a chance on something like that? Crazy! Not many, I assure you. But let's take a few steps back. Instead of just one company, let's take a look at a bunch of companies together. And let's look at 90 years versus just one.
The United States S&P 500 index gives us just that. It's a measurement of how 500 companies have performed over time. And since 1928, it has grown by an average of 10% per year.
Sure, there were some ups and downs, but what looks like a recipe for motion sickness up close tells an entirely different story when viewed with a wider angle lens. From a broader perspective, it's not unpredictable at all.
So the question then becomes, how do you get your portfolio, the collection of stocks you own, to mirror that steady increase? Well, there are two main approaches. One, diversification, and two, long-term investing stock.
We'll start with diversification. Diversification means owning stocks from a lot of different companies, which protects you from the volatility of any specific sector. And long-term investing, owning stocks for at least 10 years, protects you from the volatility of any one bad day, even a really bad day.
Every time the market crashes, people rush to sell off stocks and eat the losses. The few who either had the ability or foresight to stay in the market eventually make back that money plus some.
Behavioral economist Richard Thaler recommends very rarely checking in on your portfolio. Reason being, people who regularly track the prices of their stocks tend to get spooked and sell when they temporarily dip.
This basically guarantees that they are sold for a price that is less than they were bought at. Bummer!
Some folks have suggested that the stock market is like a casino. But these strategies reveal how different from the casino the stock market actually is. Let's look at the gambling capital of the world. Casinos in Las Vegas have payout percentages that average in the mid-90s, meaning they pay back in winnings around 95% of the money that is gambled. So, if you played Las Vegas like a stockbroker, diversifying your portfolio by playing a bunch of different games, and long-term investing by keeping your money on the table whether you win or lose each day, you can be certain that you would steadily lose 5% of your savings. Of course, there is still some risk involved. Even a diversified portfolio can take a dive, and when life deals you a bad card, you might need that money now, not 5 or 10 years down the road when the market bounces back.
So, is it smarter to just keep your money in a savings account? Well, not quite. People are increasingly on their own when it comes to saving for retirement. And as the cost of living continues to rise and everything gets more expensive, if your savings are not somehow tied to overall growth of the economy, you will get left behind.
So about that savings account, that'll be a negative. A bank may keep your money safe, but it doesn't make it grow. Do the math. The numbers don't lie.
Moral of the story? Not playing the stock market carries its own inherent risks. So, where do you start?
Most people buy and sell individual stocks through companies called brokerage firms. At the brokerage firm, the investor has a brokerage account.
It's pretty easy to set up an account, and they offer guidance on how to invest your money.
For a fee, of course. I mean, you can always pick the stocks yourself, but if you're not on top of things, that can be as risky as a slot machine.
Another more common way to own stocks is through mutual funds. Mutual funds are pre-assembled bundles of stocks and other investments that are designed in advance to be diversified and spread out the risk.
Mutual funds pool money from the investing public and use that money to buy other securities, usually stocks and bonds.
The average mutual fund holds hundreds of different securities, which means mutual fund shareholders gain important diversification at a very low price.
So which way do you go? Well, as with any big decision, the first step is to seek out the help of an advisor. The point of the advisor is to help you make a plan that fits your unique situation. Remember, even if you keep your cash under your mattress, you're still a part of the larger economy, which means in some way, form, or fashion, you're already invested in the game.
If that's the case, you might as well be playing with some strategy. And that's it for this episode of Money Talks.